What if I told you that most people working 30 or 40 years will still feel financially insecure the day they retire? Not because they didn't work hard, not because they didn't save something, but because they followed incomplete advice. Retirement isn't just about putting money into a 401k and hoping for the best. It's not just about picking good investments. It's not just about waiting until 65. And it's definitely not just about crossing your fingers that the market cooperates. There are 6 strategic layers to building real retirement security. Miss 1, and you create stress. Ignore 2, and you increase risk. Ignore 3, and retirement becomes a gamble. In this video, I'm going to walk you through a complete system. How to maximize employer plans. How to use IRAs strategically. How to turn HSAs into stealth retirement accounts. How to invest intelligently instead of emotionally. How your working habits can make or break your plan. And how guaranteed income can eliminate the fear of running out of money. This is not surface-level advice. This is the structure behind financial confidence. By the end of this video, you won't just understand retirement accounts. You'll understand how to design a retirement life. If you care about freedom, stability, and never having to wonder whether you'll outlive your money, stay with me. Let's build this the right way. Please like, subscribe, turn on notifications, and comment the next video topic in the comments. If you only do one thing right for retirement, make it this. Before you pick stocks, before you worry about real estate, before you even think about side businesses, maximize your employer-sponsored retirement plan. For most people, a 401k or 403b is the single most powerful wealth-building tool available. It combines automation, tax advantages, employer contributions, and compound growth in a way that is incredibly difficult to replicate anywhere else. And yet, millions of people underuse it every single year. In this chapter, we're going to break down exactly how to turn your employer plan into a long-term wealth machine. We'll cover employer matching, contribution strategies, tax decisions, vesting schedules, rollovers, and how to steadily increase your retirement savings without feeling the pain. Let's start with the most important concept of all, the employer match, the closest thing to free money. If your employer offers a match and you are not contributing enough to receive the full match, you are leaving money on the table. An employer match typically works like this. Your company agrees to match a percentage of your contributions up to a certain limit. For example, they might match 100% of the first 4% of your salary that you contribute, or they may match 50% of the first 6%. Here's what that really means. If you earn $60,000 per year and your employer matches 100% of the first 4%, that means if you contribute $2,400, they contribute another $2,400. That is an immediate 100% return on your money. There are no investments in the world that offer a guaranteed 100% return overnight. But this does. That is why the first rule of retirement investing is simple. Contribute at least enough to capture the full employer match. If you do nothing else, do this. Even if you are paying off debt, even if money feels tight, even if investing feels intimidating, start there. Because the match is not just extra money. It is the foundation of compound growth. Automation, make it effortless. One of the greatest strengths of employer-sponsored plans is automation. When contributions come directly from your paycheck before you ever see the money, saving becomes painless. You don't have to decide every month whether to invest. You don't have to transfer funds manually. It happens automatically. This removes emotion from the equation. And emotion is often the biggest enemy of long-term investing. When markets drop, people panic. When markets rise, people get greedy. When life gets busy, people forget to invest. Automation eliminates all of that. The key is to treat retirement contributions like a non-negotiable bill. Just like rent, just like utilities, just like taxes. You don't debate whether to pay those. You don't skip them if the market feels uncertain. You commit. A powerful strategy here is to set your initial contribution rate at a level that feels manageable, then increase it gradually over time. Many employer plans even allow you to schedule automatic annual increases. Which brings us to the next important principle. Increase contributions every year. Saving 10 to 15% of your income is a strong long-term goal for retirement. But if you're not there yet, don't panic. Instead, build toward it. One of the smartest strategies is to increase your contribution rate by 1 to 2% each year, especially when you receive a raise. For example, if you get a 3% raise, Increase your 401k contribution by 1 or 2%. You'll still take home more money than before, but a larger portion will be building your future. This strategy works because it leverages lifestyle adjustment. When your income rises, it's easy to let your expenses rise with it. Bigger apartment, newer car, more subscriptions. Instead, direct a portion of that increase toward retirement. Over time, these small increases make an enormous difference. If you start at 5% and increase by 1% each year, in 10 years you're saving 15% without ever feeling a dramatic sacrifice. That is how sustainable wealth is built. Understanding traditional versus Roth contributions. Most employer-sponsored plans allow you to choose between traditional and Roth contributions. This decision affects when you pay taxes. With traditional contributions, you receive a tax deduction now. Your taxable income decreases today, but when you withdraw the money in retirement, you pay taxes on it. With Roth contributions, you pay taxes now. There is no immediate deduction. But in retirement, withdrawals are tax-free. So which is better? It depends on your tax bracket today compared to what you expect in retirement. If you believe you are currently in a lower tax bracket than you will be later in life, Roth contributions can be powerful. You pay taxes now at a lower rate and enjoy tax-free income later. If you are currently in a high tax bracket and expect lower income in retirement, traditional contributions may make more sense. Many people choose to split contributions between both options. This creates tax diversification, giving you flexibility in retirement. The key is not perfection. The key is consistency. Because the biggest mistake is not choosing the wrong tax type. The biggest mistake is not contributing at all. Vesting. Know what you actually own. Employer matches often come with a vesting schedule. This means you may not immediately own 100% of the employer contributions. There are two common types of vesting. Cliff vesting means you become fully vested after a specific number of years. For example, after 3 years, you own 100% of employer contributions. Before that, you own none. Graded vesting means ownership increases gradually over time. For example, 20% after 1 year, 40% after 2 years, and so on. Why does this matter? Because if you change jobs before you are fully vested, you may forfeit part of your employer match. If you are considering leaving a job and you are close to becoming fully vested, it may be worth waiting a little longer to secure that money. Always review your vesting schedule. It is part of your total compensation. Investment choices inside your plan. Once you contribute to your 401k or 403b, you still need to choose how that money is invested. Most plans offer a range of options including index funds, actively managed funds, bond funds, international funds, target date funds, company stock. The biggest mistake here is staying in cash. Many people contribute for years but never select investments. Their money sits in a money market fund earning minimal returns. Make sure your contributions are actually invested. For beginners, target date funds can be an excellent option. These funds automatically adjust your asset allocation over time. When you are young, they emphasize stocks for growth. As you approach retirement, they gradually shift toward bonds and more conservative investments. If you prefer more control, you can build your own diversified portfolio using stock index funds, bond funds, and international exposure. The key principle is diversification. Do not put all your money into one company's stock. Do not concentrate everything in one sector. Spread risk across different asset classes. This reduces volatility and increases long-term resilience. Avoid cashing out when you change jobs. One of the most damaging financial decisions people make is cashing out their 401k when they leave a job. When you withdraw funds before retirement age, you typically face taxes and penalties. But even worse than that is the lost compound growth. Imagine withdrawing $30,000 at age 30. If that money had remained invested and grown at an average annual rate of 7%, it could become over $225,000 by age 65. Cashing out destroys decades of potential growth. Instead, you have better options. You can roll your 401k into your new employer's plan, or you can roll it into an IRA. Both options allow your money to continue growing tax-advantaged. Think of your retirement savings as untouchable. Not emergency money, not vacation money, not house down payment money, future freedom money, contribution limits, and maximizing them. Employer-sponsored plans have annual contribution limits. These limits are set by law and typically increase over time. If you can afford to contribute up to the maximum, this significantly accelerates your wealth building. For high earners, maxing out a 401k every year for decades can result in a multi-million-dollar retirement portfolio. But even if you cannot max it out today, work toward increasing your contribution rate over time. A powerful long-term strategy is this. First, contribute enough to receive the full employer match. Second, increase contributions toward 10 to 15% of income. Third, aim to eventually max out the annual limit if possible. This layered approach keeps things realistic and sustainable. The psychological advantage. There is also a psychological advantage to employer-sponsored plans. Because the money is harder to access, it protects you from yourself. Unlike a regular brokerage account, withdrawing funds from a 401k comes with consequences. That friction can prevent impulsive decisions. In many ways, retirement accounts are behavioral guardrails. They encourage long-term thinking. They discourage short-term panic. They reward patience. And patience is the secret ingredient in compound growth. The long-term impact of starting early. Time is the most powerful force in investing. If you start contributing at age 25 versus age 35, the difference in retirement wealth can be massive, even if the contribution amounts are the same. Why? Because compound growth accelerates over time. In the early years, growth seems slow. In the middle years, it becomes noticeable. In the final years, it becomes exponential. Starting early gives your money more time to multiply. But if you are starting later, do not give up. Consistency still wins. Even 20 years of disciplined investing can produce life-changing results. The key is to begin, turning your 401k into a wealth engine. Let's zoom out. A properly used employer-sponsored retirement plan is not just a savings account. It is a long-term wealth engine. It combines automatic contributions, tax advantages, employer matching, compound growth, diversified investments, behavioral discipline. When all of these work together, the results can be extraordinary. But none of it works without action. Contribute. Increase gradually. Invest wisely. Avoid withdrawals. Stay consistent. And over time, what feels like small monthly deductions can turn into financial independence. Because retirement planning is not about hitting a perfect number tomorrow. It is about building momentum year after year. And your employer-sponsored plan is where that momentum begins. In the next chapter, we'll expand beyond employer plans and explore how individual retirement accounts can give you even more flexibility, tax advantages, and control over your future. But remember this. If you maximize your employer-sponsored plan consistently over decades, you are already far ahead of the majority of people. The question is not whether it works. The question is whether you will use it to its full potential. Are you capturing every dollar your employer is willing to give you? If your employer-sponsored plan is the foundation of your retirement strategy, your IRA is the expansion pack. This is where you gain flexibility. This is where you gain control. This is where you build tax strategy into your long-term wealth plan. Most people stop at their 401k or 403b. They assume that's enough. But if you want to accelerate your retirement timeline, increase tax efficiency, and create more investment freedom, you need to understand how to use individual retirement accounts the right way. In this chapter, we're going deep. We'll break down Roth IRAs, traditional IRAs, self-employed options, contribution strategies, income limits, tax planning, rollovers, backdoor strategies, and how to use IRAs to create long-term compounding machines that operate alongside your employer plan. Let's start with the big picture. Why IRAs matter, even if you have a 401k. An IRA is not a replacement for your employer plan. It's a complement. While employer-sponsored plans offer matching and payroll automation, IRAs offer flexibility and broader investment choices. With an IRA, you are not limited to the small menu of funds your employer provides. You can typically choose from index funds, individual stocks, bonds, ETFs, REITs, dividend-focused funds, and in some cases, alternative assets. That expanded investment universe matters. It allows you to build a portfolio aligned with your personal strategy instead of simply picking from what's available. More importantly, IRAs allow you to strategically control taxes. And taxes are one of the biggest long-term wealth variables most people underestimate. Roth IRA. Pay taxes now, freedom later. The Roth IRA is one of the most powerful retirement tools ever created. Here's how it works in simple terms. You contribute money that has already been taxed. The money grows tax-free. In retirement, withdrawals are tax-free. That means decades of growth without future tax bills. Imagine investing $6,000 per year for 30 years. If that grows into several $100,000, every dollar you withdraw in retirement is yours. No income tax. No surprises. That's powerful. But why would anyone choose to pay taxes now instead of later? Because of tax brackets. If you are early in your career and earning less than you expect to earn in the future, your current tax rate may be lower than your retirement tax rate. In that case, paying taxes now makes sense. Roth IRAs are especially powerful for young professionals, people expecting strong career growth, anyone who values tax-free income later, those who want flexibility in retirement withdrawals. Another overlooked advantage is that Roth IRAs do not require minimum withdrawals during your lifetime. That gives you more control over how and when you use the money. It also makes Roth IRAs useful for estate planning and leaving tax-free assets to heirs. Traditional IRA, tax relief now. The traditional IRA works differently. You may receive a tax deduction on your contributions today. That reduces your taxable income now. The money grows tax-deferred. But withdrawals in retirement are taxed as ordinary income. This structure benefits people who are currently in a higher tax bracket, expect lower income in retirement, want immediate tax relief. For example, if contributing to a traditional IRA reduces your taxable income enough to lower your current tax bill significantly, that could free up additional money to invest elsewhere. But here's the key. You are deferring taxes, not eliminating them. Eventually, the government will collect taxes when you withdraw the funds. So the decision between Roth and traditional comes down to timing. Pay taxes now or pay taxes later. There is no universal answer. But there is a powerful strategy that many people overlook. Tax diversification. Instead of choosing only one type of account, consider building both tax-free and tax-deferred buckets. This creates flexibility in retirement. Imagine entering retirement with a traditional 401k, a Roth IRA, a brokerage account. Now you have options. In a year where you need less taxable income, you can withdraw from Roth accounts. In a year where your taxable income is already low, you can draw from traditional accounts strategically. This control can reduce lifetime taxes significantly. Tax diversification is not just about savings. It's about flexibility, contribution limits, and consistency. IRAs have annual contribution limits. While those limits may seem small compared to employer plans, they add up significantly over decades. The mistake most people make is thinking small contributions don't matter. But let's do the math conceptually. Contributing consistently for 30 years, even at moderate growth rates, can produce hundreds of thousands of dollars. Consistency beats intensity. You don't need to max out immediately. You need to contribute every year. And ideally, automate it. Set up automatic monthly contributions into your IRA. Treat it like another bill. Remove emotion from the process. Because the power of an IRA is not in one big deposit. It's in 20 to 40 years of disciplined deposits. Income limits and eligibility. Roth IRAs have income limits. If you earn above certain thresholds, direct Roth contributions may not be allowed. Traditional IRAs also have rules regarding deductibility if you are covered by a workplace retirement plan. This is where planning becomes important. If you are above the Roth income limit, there may still be strategies available, such as contributing to a traditional IRA and converting to Roth later. But the key takeaway is this. Don't assume you're ineligible without checking. Many people mistakenly believe they can't contribute when they actually can. And even if deductibility is limited, the tax-deferred growth still has value. Backdoor Roth strategy. For higher earners, the backdoor Roth strategy is a way to contribute indirectly to a Roth IRA. The general concept involves contributing to a traditional IRA and then converting it to Roth. However, this requires careful attention to tax rules, especially if you have other pre-tax IRA balances. This is where professional tax guidance can be valuable. The broader lesson is that retirement planning becomes more strategic as income rises. And the higher your income, the more valuable tax efficiency becomes. IRAs for the self-employed. If you are self-employed or run a small business, your retirement options expand significantly. You are not limited to standard IRAs. Options may include SEP IRA, Solo 401k, Simple IRA. These accounts often have much higher contribution limits than standard IRAs. For example, a self-employed individual can potentially contribute both as employer and employee in a Solo 401k, dramatically increasing retirement savings potential. This is one of the greatest advantages of entrepreneurship. If you have variable income, self-employed retirement plans allow you to contribute more in strong years and less in lean years. That flexibility is powerful. And because business owners often lack employer matching, these plans allow them to create their own matching system. Investment freedom inside an IRA. Unlike many employer-sponsored plans, IRAs typically allow you to choose almost any publicly traded investment. This means you can build a low-cost index fund portfolio, create a dividend income strategy, add international diversification, invest in REITs, adjust allocations as your goals change. The freedom is both an opportunity and a responsibility, because with more choice comes more risk of poor decisions. Avoid overtrading. Avoid chasing trends. Avoid concentrating too heavily in speculative assets. Instead, build a diversified, long-term portfolio aligned with your time horizon. The goal of an IRA is not excitement. It's stability and growth. Roth conversion strategy in mid-career. As you approach mid-career or early retirement, Roth conversions can become a powerful tax planning tool. If you experience a year with unusually low income, converting some traditional IRA funds to Roth may allow you to pay taxes at a lower rate than you would later. This gradually shifts your retirement assets into tax-free territory. But timing matters. Converting large amounts during high-income years can create large tax bills. Strategic conversions require careful planning. The principle remains simple. Use lower tax years to reposition assets, avoiding early withdrawal mistakes. IRAs are designed for retirement. Withdrawing funds early can result in taxes and penalties. But the real cost isn't just the penalty. It's lost compound growth. When you withdraw retirement money early, you are stealing from your future self. That money was meant to grow for decades. Treat your IRA as long-term capital, not emergency savings, not opportunity capital, not short-term cash. If you need liquidity, build a separate emergency fund. Protect your retirement accounts at all costs. Building retirement layers. Think of your retirement plan as layers. Layer 1, employer-sponsored plan. Layer 2, IRA. Layer 3, taxable investments. Layer 4, additional income streams. Each layer increases resilience. Each layer increases flexibility. Each layer increases long-term stability. IRAs are a critical middle layer. They bridge the gap between employer plans and independent investing. And over decades, that bridge can become one of your largest wealth pillars. The real power of control. There is something psychologically powerful about managing your own IRA. It shifts you from passive participant to active planner. You are not just checking a payroll box. You are building a strategy. You are deciding how your money grows. You are shaping your future income. That sense of control increases engagement. And engagement increases consistency. Because when you understand your plan, you are more likely to stick with it. Bringing it all together. Let's zoom out again. An IRA gives you tax flexibility, investment freedom, additional contribution space, strategic conversion opportunities, control over your long-term plan. When combined with your employer-sponsored account, it accelerates wealth accumulation significantly. But only if you use it. Open the account. Automate contributions. Choose diversified investments. Stay consistent. Adjust strategically over time. In the next chapter, we'll explore one of the most underused and misunderstood retirement tools available, the health savings account. Most people think of it as just a medical spending account. But when used strategically, it can become one of the most tax-efficient retirement vehicles in existence. And the advantages may surprise you. Before we move on, ask yourself, are you using your IRA to its full potential? Or are you leaving another powerful wealth tool sitting idle? Most people think of a health savings account as a place to park money for doctor visits and prescriptions. That's it. They see it as a short-term spending account, not a long-term wealth tool. But when used strategically, an HSA can quietly become one of the most powerful retirement accounts available. In fact, it has a tax advantage that no other account fully matches. Triple tax advantage. Contributions can reduce your taxable income. The money grows tax-free. Withdrawals for qualified medical expenses are tax-free. No other retirement vehicle combines all three in the same way. And yet, most people either underfund it, spend it immediately, or ignore it completely. In this chapter, we're going deep into how HSAs really work, how to turn them into long-term investment engines, and how they can protect your retirement plan from one of the biggest financial threats in later life: healthcare costs. Let's start with the basics. What is an HSA really? An HSA is available to individuals enrolled in a high-deductible health plan. If you qualify, you can contribute money into the account each year. The contributions reduce your taxable income. The funds can be invested. The growth is not taxed. And withdrawals for qualified medical expenses are not taxed. That's powerful. But the key word there is invested. Most people leave HSA money in cash. They treat it like a checking account. And that's where the opportunity is lost. The hidden retirement account. Here's the mindset shift that changes everything. Stop thinking of your HSA as a medical spending account. Start thinking of it as a stealth retirement account. Medical expenses in retirement are almost guaranteed. That's not pessimism. It's reality. As we age, healthcare spending rises. Even with insurance, out-of-pocket costs can be significant. Now imagine entering retirement with a separate pool of tax-free money specifically designed to handle those expenses. That means your 401k, IRA, and brokerage accounts don't have to shoulder that burden. That separation creates flexibility and security. Why HSAs can be more powerful than IRAs. Let's compare structures in simple terms. A traditional IRA gives you a tax deduction now, tax-deferred growth, and taxable withdrawals later. A Roth IRA gives you no deduction now, tax-free growth, and tax-free withdrawals later. An HSA can give you a tax deduction now, tax-free growth, tax-free withdrawals for qualified expenses. That's better than both, if used correctly. There is one catch. Withdrawals must be used for qualified medical expenses to remain tax-free. But here's where it gets interesting. After age 65, you can withdraw HSA funds for non-medical expenses without penalty. You'll pay ordinary income tax on those withdrawals, similar to a traditional IRA. So worst-case scenario, it behaves like a traditional IRA. Best-case scenario, it behaves even better. That flexibility makes it extremely attractive. The long-term investment strategy. Here's the strategy many financially savvy individuals use. They contribute to their HSA every year. They invest the funds in diversified assets. They pay current medical expenses out of pocket instead of using the HSA. They keep receipts for qualified expenses. They let the HSA grow for decades. Why pay out of pocket? Because it allows the invested HSA money to compound uninterrupted. And here's the key rule. You can reimburse yourself for past qualified medical expenses at any time, as long as the expense occurred after the HSA was established. There is no expiration date on reimbursement. That means you could pay a $1,000 medical bill today from your checking account, save the receipt, and reimburse yourself 20 years later from a much larger, tax-free HSA balance. That strategy turns the HSA into a long-term compounding machine. Contribution strategy and consistency. HSA contribution limits are set annually. While they may be smaller than 401k limits, they still add up significantly over time. Let's think long-term. If you consistently max out your HSA for 25 to 30 years and invest it in a diversified portfolio, the balance can grow into a substantial retirement resource. And unlike some retirement accounts, HSA funds roll over indefinitely. There's no use it or lose it rule like flexible spending accounts. That rollover feature is critical. It allows the account to become a true long-term investment vehicle. Investment options inside an HSA. Many HSA providers allow you to invest in index funds, ETFs, bond funds, target date funds. However, some providers require you to keep a minimum amount in cash before investing the rest. It's important to understand your provider's rules. If your employer's HSA provider has limited options or high fees, you may be able to transfer your balance to another HSA custodian with better investment choices. Lower fees matter. Over decades, high expense ratios can erode thousands of dollars in potential growth. Treat your HSA investments with the same discipline as your IRA or 401k. Diversify. Stay consistent. Avoid frequent trading. Focus on long-term growth. Healthcare costs in retirement. One of the biggest unknowns in retirement planning is healthcare. Even with government programs available later in life, retirees often face premiums, deductibles, copays, prescription costs, long-term care expenses. These can add up quickly. Without planning, healthcare costs can force retirees to withdraw more from taxable retirement accounts than planned. That increases taxes and reduces long-term sustainability. But if you have a well-funded HSA, you can use those funds to cover qualified medical expenses without increasing your taxable income. That keeps your tax bill lower. It also preserves other retirement assets. That separation provides stability. HSA after age 65. After age 65, the HSA becomes even more flexible. Withdrawals for non-medical expenses are allowed without penalty. You simply pay ordinary income tax, similar to a traditional IRA. But withdrawals for qualified medical expenses remain tax-free. So you have options. If you need extra income 1 year, you can use HSA funds like a traditional IRA. If you face significant medical costs, you can withdraw tax-free. That dual functionality is rare. Coordination with Medicare. When you enroll in certain government healthcare programs later in life, you can no longer contribute to an HSA, but you can still use the funds already accumulated. That means the growth window typically occurs during your working years, which reinforces the importance of starting early. The earlier you begin contributing and investing, the longer the compounding period. Compound growth and the healthcare buffer. Let's zoom out again. Imagine entering retirement with a 401k, an IRA, a taxable brokerage account, and a large HSA. Now imagine facing a $10,000 medical expense. Without an HSA, you withdraw $10,000 from your traditional IRA. That withdrawal increases your taxable income. That may increase your tax bracket. That could even affect other benefits. With an HSA, you withdraw $10,000 tax-free. Your taxable income stays the same. That difference compounds over time. The HSA acts as a buffer. It protects your tax strategy. It protects your retirement withdrawal plan. It adds resilience. Common mistakes to avoid. Spending contributions immediately instead of investing. Leaving the balance entirely in cash for decades. Failing to understand contribution eligibility rules. Ignoring investment fees. Not keeping records of medical expenses. The receipt strategy requires organization. Keep digital copies. Track dates and amounts. Store documentation securely. This isn't about gaming the system. It's about using the rules correctly and strategically. Pairing HSAs with other retirement accounts. Your retirement system works best when accounts complement each other. 401k for large-scale tax-deferred growth. Roth IRA for tax-free income. HSA for tax-free medical coverage and flexible withdrawals. Each account solves a different problem. Together, they create balance. And balance reduces risk. The psychological advantage. There's also peace of mind in knowing healthcare expenses are covered. Medical costs are one of the biggest fears people have about retirement. Having a dedicated, tax-efficient fund reduces that anxiety. It makes retirement planning feel more complete. And when anxiety decreases, decision-making improves. You're less likely to panic during market downturns. You're less likely to overspend or underspend. You operate from stability instead of fear. The bigger picture. An HSA is not a replacement for your 401k. It's not a replacement for your IRA. It's an enhancement, a layer, a strategic tool. And like every powerful financial tool, its impact depends on how you use it. If you treat it as short-term spending money, it stays small. If you treat it as a long-term investment vehicle, it becomes transformational. In the next chapter, we'll move beyond account types and focus on how to invest inside those accounts. Because choosing the right structure is only half the equation. The other half is deciding what you actually own. Asset allocation, diversification, risk management, income generation, and how to adjust as you move closer to retirement. Before we move on, ask yourself, are you using your HSA as a simple medical account, or are you building a tax-free healthcare fortress for your future? You can contribute to every retirement account available. You can automate perfectly. You can max everything out. You can follow every tax rule correctly. But if your investment strategy is weak, inconsistent, or emotional, your results will suffer. Accounts are containers. Investments are the engine. And in this chapter, we're going to focus entirely on that engine. Because how you invest inside your 401k, IRA, HSA, or brokerage account will determine whether your retirement plan simply survives or truly thrives. We're going to break down diversification, asset allocation, index investing, target date funds, dividend strategies, real estate exposure, risk management, and how to avoid the behavioral mistakes that quietly destroy long-term wealth. Let's start with the most important principle. Asset allocation is everything. If you remember one concept from this entire chapter, let it be this. Your mix of assets matters more than your individual stock picks. Asset allocation is the percentage of your portfolio invested in categories like stocks, bonds, cash, international investments, real estate. This mix determines your expected return, your volatility, your drawdown risk, your emotional stress level during market downturns. Many investors obsess over finding the perfect stock. But long-term research consistently shows that overall allocation drives the majority of portfolio outcomes. Why? Because markets move in cycles. Stocks can surge for years, then decline sharply. Bonds can stabilize portfolios. International markets can outperform domestic markets for long stretches, then reverse. No one asset class wins forever. Diversification exists because uncertainty exists. The power of diversification. Diversification simply means spreading your investments across different types of assets so that no single event can devastate your entire portfolio. If you invest everything in one stock and it fails, your retirement plan collapses. If you spread investments across hundreds or thousands of companies through diversified funds, individual failures become minor blips. Diversification reduces risk without necessarily reducing long-term return potential. It smooths the ride. And smoothing the ride matters more than most people realize. Because the biggest threat to your retirement plan isn't market volatility. It's your reaction to market volatility. Diversification reduces panic. Reduced panic increases consistency. Consistency fuels compounding. Stocks, the growth engine. Stocks represent ownership in companies. Over long periods, stocks have historically provided higher returns than bonds or cash because they carry more risk. For younger investors with decades until retirement, a higher allocation to stocks often makes sense. Time is your greatest asset. You can withstand short-term volatility because you have long-term runway. But here's the nuance. Not all stock exposure needs to be aggressive or speculative. Broad market index funds allow you to own hundreds or thousands of companies at once. Instead of trying to guess which company will win, you participate in overall economic growth. That reduces the risk of catastrophic loss from one failed company. International exposure adds another layer. Economies grow at different rates. Currencies fluctuate. Political cycles vary. Owning global assets prevents your retirement from depending entirely on one country's performance. Bonds, the stabilizer. Bonds often receive less attention because they don't offer explosive returns. But bonds serve a critical role. They provide income. They reduce volatility. They often move differently than stocks during market stress. As retirement approaches, the importance of stability increases. If you are withdrawing income from your portfolio, large market swings can become dangerous. A well-structured bond allocation can reduce the risk of being forced to sell stocks during downturns. Bonds aren't about excitement. They're about protection. And protection matters more as your timeline shortens. Target date funds, the autopilot option. For investors who don't want to manage allocation manually, target date funds offer simplicity. These funds automatically adjust the stock-to-bond ratio over time. When you're younger, the fund holds more stocks. As you approach retirement, it gradually shifts toward bonds and more conservative assets. This approach removes guesswork. It also removes the temptation to constantly tweak allocations based on headlines. The trade-off is less customization. But for many people, simplicity increases discipline, and discipline often beats complexity. Dividend stocks and income-producing assets. Some investors prefer to build portfolios that generate ongoing income. Dividend-paying stocks distribute a portion of profits to shareholders. Real estate investment trusts distribute income from property holdings. These can create predictable cash flow. In retirement, that income can reduce the need to sell assets. However, income strategies still require diversification. Chasing high dividends without evaluating overall financial health can introduce risk. A sustainable dividend is more important than a large one. Income is powerful, but sustainability is essential. The role of REITs. Real estate investment trusts allow investors to gain exposure to real estate without directly owning property. They can provide income and diversification. Real estate often behaves differently than traditional stocks and bonds. Adding a modest allocation to real estate can enhance portfolio balance. But like any asset class, it should be part of a diversified strategy, not the entire plan. Risk tolerance versus risk capacity. This distinction is crucial. Risk tolerance is emotional. Risk capacity is mathematical. You may feel comfortable with aggressive investments, but if you are 5 years from retirement, your capacity for large losses is limited. On the other hand, you may feel nervous about stock volatility, but if you're 30 years from retirement, your capacity for risk is high. Your portfolio should align with both. Not just what feels comfortable, not just what promises high returns, but what fits your timeline and financial reality. Rebalancing, the discipline tool. Over time, market performance will shift your allocation. If stocks outperform bonds, your portfolio may become more stock-heavy than intended. Rebalancing restores your target allocation. This forces a disciplined behavior, selling assets that have grown beyond your target, buying assets that have lagged. It sounds simple, but emotionally, it's difficult. You're trimming winners. You're buying underperformers. Yet this systematic process maintains risk control. It keeps your strategy intact, and it prevents your portfolio from drifting into unintended risk levels. Avoiding emotional investing. Market headlines are designed to provoke reaction, fear, excitement, urgency. But retirement investing is a long game. Reacting to short-term noise often leads to buying high, selling low, missing recoveries, overconcentration in trendy assets. The most successful retirement investors are not the smartest traders. They are the most consistent. They stay invested. They follow allocation rules. They rebalance periodically. They ignore daily volatility. Compound growth requires time. Time requires patience. Patience requires discipline. Sequence of returns risk. As retirement approaches, a new concept becomes critical. Sequence of returns risk. If large market losses occur early in retirement while you're withdrawing income, the long-term impact can be severe. That's why asset allocation typically becomes more conservative closer to retirement. The goal shifts from maximizing growth to protecting sustainability. A strong retirement plan balances growth and preservation. Growth builds the nest egg. Preservation protects it, keeping costs low. Investment fees may seem small, but over decades, they compound just like returns. High expense ratios quietly erode wealth. Choosing low-cost index funds or diversified ETFs can significantly increase long-term outcomes. The difference between paying 0.1% and 1% annually may not sound dramatic, but over 30 years, it can represent tens or even hundreds of thousands of dollars. Fees matter more than most investors realize. Staying the course during downturns. Market downturns are inevitable. They are not anomalies. They are part of the cycle. The investors who succeed long-term are those who remain invested during declines, selling during panic locks and losses. Staying invested allows recovery. Historically, markets have recovered from recessions, crises, and uncertainty. But recovery rewards those who stay disciplined. This doesn't mean ignoring legitimate changes in your financial situation. It means separating strategy from emotion. Investing inside every account. The principles we've discussed apply inside every retirement account. Your 401k, your IRA, your HSA. Each should reflect a coherent overall allocation. Avoid treating each account in isolation. Look at your entire portfolio across all accounts combined. That big picture view ensures alignment with your goals. The long-term perspective. Retirement investing is not about predicting the next year. It's about building a structure that can withstand decades. Markets will rise. Markets will fall. Economic cycles will shift. Political climates will change. Your strategy must be durable enough to survive all of it. Durability comes from diversification, from allocation discipline, from cost awareness, from emotional control. In the next chapter, we shift from investing mechanics to behavior and work strategy. Because how long you work, how you manage debt, and how you plan for government benefits can dramatically influence how much you need to save. And sometimes, small adjustments in working years can create massive differences in retirement security. Before we move on, ask yourself, is your investment strategy built for headlines or built for decades? Most people think retirement success is about investing. And yes, investing matters. But here's the truth that often gets overlooked. Your work decisions can impact your retirement outcome just as much, and sometimes more, than your investment returns. How long you work, how consistently you earn, how you manage debt, when you claim government benefits, how you transition into retirement. These choices shape your financial future in powerful ways. In this chapter, we're going to step away from account types and market strategy and focus on behavior. Because retirement isn't just a math problem. It's a life design problem. And small strategic decisions during your working years can dramatically reduce stress later. Let's start with one of the most underestimated advantages in retirement planning. Working longer is a force multiplier. There's a common narrative that retirement is about escaping work as early as possible. But financially speaking, even a few extra working years can transform your outlook. Why? Because working longer creates a triple advantage. First, you continue contributing to retirement accounts. Second, your investments continue compounding without withdrawals. Third, you shorten the number of years your savings must support you. That combination is powerful. Imagine someone planning to retire at 62. If they instead work until 65 or 67, that's several additional years of contributions and growth, plus fewer years of withdrawals. It reduces pressure dramatically, and it can increase long-term security far more than chasing slightly higher investment returns. This doesn't mean you must work forever. It means flexibility and timing can create enormous leverage. The psychology of work and identity. Work is more than income. It provides structure, social interaction, purpose, identity. For many retirees, the hardest part of retirement isn't financial, it's psychological. A sudden stop from full-time work to full retirement can feel disorienting. That's why phased retirement is gaining popularity. Instead of stopping abruptly, some people reduce hours gradually, shift into consulting, work part-time in a different field, transition into passion-driven projects that still generate income. This approach can smooth both financial and emotional adjustment. It also reduces the immediate drawdown on retirement savings. Even modest income during early retirement years can significantly preserve portfolio longevity. Managing debt before retirement. Debt is one of the most overlooked retirement risks. Car loans, credit cards, personal loans, high-interest balances. Entering retirement with significant high-interest debt creates pressure. Monthly payments reduce flexibility. Interest drains cash flow. Unexpected expenses become harder to manage. Strategic working habits include aggressively eliminating high-interest debt before retirement. Paying off credit cards and consumer debt should be a priority long before your final working year. Mortgage decisions are more nuanced. Some retirees prefer to enter retirement mortgage-free. Others maintain low-rate mortgages and preserve investment capital. There's no one-size-fits-all answer. But the key principle is this. The lower your fixed expenses in retirement, the lower your required withdrawals. And lower withdrawals increase sustainability. Lifestyle inflation and its long-term impact. As income rises during working years, spending often rises with it. New car, bigger house, more travel, more subscriptions, higher fixed costs. This is called lifestyle inflation. And while enjoying life is important, unchecked lifestyle growth increases the amount you must replace in retirement. If you build a lifestyle that requires $120,000 per year, you must generate that income without employment later. If you design a lifestyle that feels fulfilling at $70,000 per year, your retirement target shrinks dramatically. Strategic workers think about this early. They focus on increasing savings rate when income rises rather than expanding expenses proportionally. A raise becomes an opportunity to boost contributions. A bonus becomes a chance to eliminate debt or invest. An unexpected windfall becomes a long-term asset instead of short-term consumption. The power of the savings rate. Investment returns matter, but your savings rate, the percentage of income you consistently set aside, is often more important, especially early in your career. Someone earning a moderate income who saves 20% consistently may build more wealth than someone earning a higher income but saving only 5%. Saving 10% to 15% of income is a strong baseline. Higher savings rates accelerate flexibility. Savings rate is controllable. Market returns are not. Strategic working habits prioritize what you can control: career strategy and income growth. Retirement planning isn't just about cutting expenses. It's also about maximizing earning potential during peak working years. Investing in skills, pursuing certifications, negotiating salary, exploring side income, switching roles for higher growth. Each incremental income increase compounds over decades. Higher income, when paired with disciplined saving, dramatically improves retirement readiness. But income growth must be paired with intentional allocation. Otherwise, it simply fuels lifestyle inflation. Emergency funds and financial stability. A strong emergency fund protects retirement contributions. Without one, unexpected expenses often lead to credit card debt, early retirement account withdrawals, missed contributions, financial stress. Maintaining several months of expenses in liquid savings provides stability. Stability protects long-term plans. Retirement planning isn't just about building wealth. It's about protecting it. Maximizing government benefits. Government retirement benefits can form a meaningful portion of retirement income. The timing of when you claim benefits matters. Claiming early may reduce monthly payments. Delaying can increase them. Strategic workers evaluate life expectancy, other income sources, spousal considerations, tax implications, portfolio withdrawal strategy. Delaying benefits can significantly increase monthly income, but it requires planning and coordination. It's not automatic. It's strategic. Healthcare and employment decisions. Employer-provided health insurance can influence retirement timing. Leaving employment before qualifying for government healthcare programs may require purchasing private coverage. That cost can be significant. Some individuals choose to work slightly longer to maintain employer healthcare coverage. Others budget carefully for transitional coverage. Understanding healthcare timing reduces surprises, and reducing surprises reduces stress. The importance of flexibility. Rigid retirement timelines can create unnecessary pressure. Life rarely unfolds exactly as planned. Health changes. Family needs shift. Economic cycles fluctuate. Strategic working habits include building optionality. Optionality means having skills that allow part-time work if needed, maintaining professional networks, avoiding complete skill atrophy, keeping credentials current, staying adaptable. Optionality is freedom. It reduces fear. It allows you to respond to circumstances rather than being trapped by them. Bridging income strategies. Some retirees use bridge income strategies. Consulting, freelancing, rental income, online businesses, teaching, advising. These income streams don't need to replace full salaries. Even modest supplemental income can reduce withdrawal pressure during volatile market years. Diversifying income sources during retirement mirrors diversification in investing. Multiple streams create resilience. Social and emotional planning. Retirement without purpose can feel empty. Strategic planning includes thinking beyond money. What will your days look like? What activities will fill your time? What communities will you engage with? Planning for social connection and meaning improves retirement satisfaction. Financial security supports emotional well-being, but emotional preparation supports financial discipline. The transition year strategy. The final working years deserve special attention. This is the time to reevaluate asset allocation, reduce high-interest debt, review insurance coverage, assess healthcare planning, project income sources, plan withdrawal strategies, adjust savings rate if possible. Many people treat retirement as a finish line, but it's actually a transition phase. A strategic transition reduces mistakes in the early years, which are often the most financially sensitive due to sequence of returns risk. The compound effect of small decisions. Choosing to work one extra year, increasing contributions by 2%, paying off a high-interest loan early, negotiating a slightly higher salary, reducing lifestyle expansion. Individually, these may seem minor. Collectively, they compound. Retirement security is rarely built on one massive breakthrough. It's built on consistent, disciplined decisions over decades. In the final chapter, we're going to explore one more layer of retirement planning: guaranteed income. Because while investments provide growth and flexibility, some people want additional stability. Annuities can play a role if understood clearly and used appropriately. but they are often misunderstood. Before we move on, ask yourself, are your working years being used strategically, or are you leaving powerful advantages on the table? At some point in retirement planning, the conversation shifts. It stops being about accumulation. It becomes about certainty. When you're working, volatility feels tolerable because income is still coming in. You can recover from market downturns. You can keep contributing. You can wait. But once you retire, the equation changes. You're no longer asking, how much can this grow? You're asking, will this last? That psychological shift is why guaranteed income strategies matter. Because retirement isn't just about maximizing returns. It's about creating confidence. And confidence comes from knowing that essential expenses are covered no matter what markets do. Let's unpack that carefully. The retirement paycheck concept. During your working years, your paycheck arrives predictably. Rent gets paid. Food gets bought. Utilities stay on. There's stability. In retirement, unless you structure it intentionally, that paycheck disappears. What replaces it? For many people, retirement income comes from three potential sources: personal savings and investments, government retirement benefits, pensions, or guaranteed income products. The more predictable your income floor is, the less stress you feel during market downturns. This is where guaranteed income enters the conversation. Government benefits as the first layer. For many retirees, government benefits form the foundation of guaranteed income. These payments are typically adjusted for inflation and last for life. The key strategic decision is timing. Claiming early provides income sooner, but reduces the monthly amount. Delaying increases monthly payments, sometimes significantly. Delaying effectively creates a higher guaranteed lifetime payout. That higher payout can reduce the need to withdraw aggressively from investments. But the right timing depends on health, life expectancy, spousal planning, and overall financial structure. There's no universal best age. There's only the age that aligns with your plan. The income floor strategy. One powerful framework in retirement planning is building an income floor. This means covering essential expenses, housing, food, utilities, insurance, with guaranteed income sources. If your essential expenses are fully covered by guaranteed income, then your investments can focus on discretionary spending, travel, gifts, lifestyle upgrades, legacy goals. This separation reduces emotional pressure. If markets drop, your lifestyle isn't immediately threatened. You're uncomfortable, but not destabilized. That difference is profound. Pensions, the traditional guarantee. Some retirees still have access to employer pensions. A pension provides monthly income for life, sometimes with survivor benefits. While less common today, pensions act similarly to personal annuities, providing predictable income. For those who have them, pensions often serve as a core income foundation. But most modern workers don't have this benefit, which leads to the next tool. Annuities, misunderstood and powerful when used carefully. Annuities are insurance contracts designed to provide income. They are often controversial. Some are expensive. Some are complex. Some are sold aggressively. But at their core, certain types of annuities can create guaranteed lifetime income. There are several categories. Immediate annuities begin payments soon after purchase. Deferred annuities begin payments later. Fixed annuities offer predictable returns. Variable annuities are tied to investment performance. Not all annuities are equal. Some are simple and transparent. Others are layered with fees and riders that reduce flexibility. The key is understanding what problem you're solving. An annuity isn't meant to maximize growth. It's meant to transfer longevity risk. Longevity risk, the quiet fear. One of the greatest retirement fears is outliving your money. No one knows exactly how long they will live. Planning too conservatively may reduce lifestyle quality. Planning too aggressively may risk running out of funds. Annuities shift that uncertainty to an insurance company. In exchange for a lump sum, you receive lifetime income. You give up liquidity and growth potential. You gain predictability. For some retirees, that trade-off is worth it. For others, flexibility matters more. There is no universal answer. Only alignment with your personal priorities. The hybrid approach. Many sophisticated retirement strategies use a hybrid model. Layer 1, guaranteed income covers essentials. Layer 2, investment portfolio provides growth and flexibility. This approach combines psychological comfort with long-term opportunity. It reduces fear-driven decisions. Because when markets drop, you're not forced to sell everything just to survive. You have a foundation. Withdrawal strategies matter. If you rely primarily on investments, how you withdraw matters. The common 4% rule is a guideline, not a guarantee. Withdrawal strategy must consider market performance, inflation, spending flexibility, tax efficiency, sequence of returns risk. Some retirees use dynamic withdrawal strategies. In strong market years, they withdraw more. In weak market years, they tighten spending. Flexibility increases sustainability. Rigid withdrawal demands increase risk. Tax efficiency in retirement. Retirement withdrawals can come from tax-deferred accounts, tax-free accounts, taxable brokerage accounts. Strategically choosing which account to draw from can reduce lifetime taxes. For example, drawing modestly from tax-deferred accounts before required distributions begin can smooth taxes over time. Using tax-free accounts strategically can prevent income spikes. Coordinating withdrawals with government benefit timing can reduce overall tax burden. Retirement isn't just about how much you have. It's about how efficiently you use it. Inflation, the silent erosion. Guaranteed income that doesn't adjust for inflation loses purchasing power over time. This is why some retirees maintain stock exposure even after retirement. Growth protects against long-term inflation. Too much safety can quietly erode lifestyle over decades. Balance is critical. Safety for stability. Growth for longevity. The emotional side of guaranteed income. Here's something often overlooked. Peace of mind has value. If a guaranteed income stream allows you to sleep better, spend confidently, and avoid panic during downturns, that benefit is real. Financial planning is not purely mathematical. It's behavioral. Confidence improves decision-making. Fear distorts it. Legacy and estate considerations. Some guaranteed income products reduce the ability to leave assets to heirs. That trade-off must be considered. If legacy is a high priority, maintaining investment flexibility may be more important. If personal lifetime security is the highest priority, guaranteed income may take precedence. Clarity about your values determines your structure. Closing the loop. Now step back. We've covered retirement accounts and tax advantages, the power of HSAs, investment strategy and diversification, working habits and income planning, guaranteed income and withdrawal strategy. What ties it all together? Intentionality. Retirement security doesn't come from one account, or one investment, or one decision. It comes from alignment. Alignment between your income and savings rate, your risk tolerance and asset allocation, your working years and retirement timeline, your guaranteed income and lifestyle needs. When these pieces fit together, stress decreases. And when stress decreases, confidence rises. The final question. Retirement isn't an age. It's a phase of life. And the question isn't simply, how much do I need? The deeper question is, what kind of life am I designing? Money is a tool. Accounts are tools. Investments are tools. Guaranteed income is a tool. But the goal isn't to accumulate tools. The goal is to build freedom. Freedom from anxiety. Freedom from instability. Freedom to choose how you spend your time. The story doesn't end at retirement. It begins there. And every strategic decision you make today shapes the confidence you carry into that next chapter. So here's the closing reflection. Are you building a retirement plan that merely survives uncertainty, or one that allows you to live fully within it? Don't forget to subscribe on your way out. See you next video.